Hey everybody, Charlie here from Canada Financial Group and also my YouTube channel, which is Lifetime Income for You. Today I'm going to do something different. I'm going to do a quick, I promise not to get long-winded, quick market update. And so let's take a quick look at the markets. Sorry, I need to share my screen so that we can begin that. And so this first article is from CNBC. It's Janet Yellen talking about inflation and admitting that she thought it would be more transitory. So it's here to stay and it's with us. The Fed has raised interest rates by 75 basis points here this past week. And they're hoping that by the end of the year, they've slowed inflation down some, okay? So that doesn't mean deflation. Prices aren't going to go back where they were right away, but they can slow the growth is what they're going to try to do. Along with that, here's from CNBC, Jamie Dimon, who, you know, he's probably the best known of the big banks CEOs. And he says that we should brace ourselves for the economic hurricane that's headed our way. And here's one of the big factors he has, as I highlighted right there, the quantitative tightening that's going to be scheduled to come this month. What does that mean, quantitative tightening? Well, in pandemic, remember how we lost 33% when we were at March 20th? And then the Fed put in about $7 trillion into the economy. Well, they're going to start pulling some of those bonds back and buying them back off of their sheets. And so that tightening could wind us all the way back to where we were. Let's take a look at the S&P. Right now, the S&P, this is off of Bloomberg.com. This is live. Of course, today is a non-market trading day. It's Monday the 20th. Here's where the S&P is right now at 3674. You can see year to date, it's negative 22. But let's take a look at this chart. If we look at the 5-year chart at 3674, if we go all the way back to March 20th of pandemic, the market was at 2304. That means that we've got another 33% that it could drop if we go back to that pandemic lows. And so we've got inflation, we've got market volatility, and of course, you've always got to be concerned about longevity risk. Those three things tell us that part of your retirement money should be in annuities. Let's take a look at how that might look. Right? Before we do that, I just want to remind you, I'm a certified financial planner. Everything I do is for the good of my well-being of my clients. And I work on the East Coast all the way here to Oregon where I live. And so if you're on the East Coast watching this and you'd like to meet, we can do it by Zoom. And if you're in Oregon, we can meet virtually on Zoom or we can meet live in person. But let's take a quick look at how annuities might work. And so in our example, we're going to compare leaving your money in the S&P 500 to an annuity that has the S&P 500 as one of the indexes you can take. Only it caps at 8.5%, but you've got a no loss guarantee. Okay, what does that mean? Here's your $100,000, and the first year the S&P goes up 10%. If you stay invested, your $100,000 is now worth $110,000, right? Everybody with me? If your money had been moved into an annuity already, and we only got the 8.5%, that annuity is at $108,500. Okay, you didn't get 100% of the upside, but here's what you get. Is the next year, if that S&P goes negative 20, your money drops to 88,000. But with the no loss guarantee, your annuity stays at 108,500. Isn't that beautiful? This difference right here is much more important than that difference right there. I guarantee you. Now, let's say we get a bounce back, because that's what the markets do, right? They don't just only go up or only go down. But let's say it bounces back 15%. Your 108 gets you back to just over even, 101,200. But your annuity got to start at 108 and went up 15. It doesn't go up 15, it goes up 8.5. So you're at 117,200. So again, a much bigger difference than this little difference in that first positive year. Now, of course, we don't know the order of returns, but all the experts are telling us the next 2, 3, 4, 5 years are going to be tough. And it's because that $7 trillion was pumped into the economy. And the only way that the Fed can make up for that is to raise interest rates, or the government raises taxes, because they've got to pay for that $7 trillion somehow. And so if that's a concern to you, you should talk to me. I specialize in de-risking people's portfolios and in guaranteed lifetime income. And so those are the things where I can help you with. If you would like to talk to me, you come to my website, cannonfg.com. That's CANNONFG.com. And in the upper right-hand corner there, here's the homepage. You hit contact. And right there on the contact page, schedule a time on my calendar. And that'll take you to all the open dates and all the open times on each date. If you're on the East Coast, Midwest, or the South, we would do a Zoom call. If you're here in Oregon, I'm happy to meet with you personally, or we can do the Zoom call, especially for that first one. So this is Charlie Cannon for Lifetime Income for You. Remember, that lifetime income for you is the most important part of your retirement. Thank you.